Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player. Good day, all. Ira Epstein of Linn & Associates with your financial market wrap-up for this Monday, and this is the 22nd of May, 2017 at 4:45 p.m. Central Daylight Time, and that's why these boards are going blank right behind me. These are the last settlement prices as they're wiping the boards clear, and this is what happens at 4:45 as the exchanges wipe the boards and then they reopen at 5 p.m. to get everything going. Now, when we take a look at what we have in the charts, let's go right to our June Dow Jones. We still have a high, and I call it an important high in this 21,010 level. We got a bump today, and let's face it, over the weekend, when you heard the President Trump had signed anywhere between $300 and $450 billion worth of deals with the Saudis, from American company after American company, it was pretty hard not to get a bump in the stock market off that. Now, admittedly, some of this stuff is 20 years down the road and so on, but it was pretty good as far as I could see, and I was impressed with that, and I think the market was too, so you got a nice little rally out of it. You're still in a down thrust though on closes. You've really got to get back over this level, this 20,950 level, to get the market coming back up. So let's call it another 70, 80 points higher. You'll do that. The question is the market capable of it? Because you had a Monday reversal. I would not be surprised if you had from the Monday up day to a Tuesday down day. In other words, setting up the reversals. I'm leaving this right up here. I think this is still an important resistance point. Very important because given the size of the break we had last week, is it still the story you can buy the deep break and the market comes up and rewards you immediately for it? Or is the market going to come up and one of these times fail and take out this previous low? I wish I could tell you the answer, but at some point we'll find out. So far, each of these deep breaks have come back sharply, as you can see, and this has become a very important area because as I step back here, you can see how the February-March period, remember, those were new all-time highs up there at that point in time. When we take a look at the swing line, the thing I look at is we have a high, a lower high at 20,995 and clearly lower lows. So the swing line is in a downtrend. The battleground is the 18-day moving average of closes. It was also that last week until it gave way. At that point, the market made a run for the 100-day moving average of closes down here. Didn't quite hit it, but since then, over the past 3 sessions, it has rallied back to the 18-day average. Does this market have enough power to get over 20,995 and just say to the market, we're going to new highs, to heck with y'all? In looking where the market stopped on the decline, very clear. The lower Bollinger Bands did their job. I would think the top Bollinger Band does its job if it gets up there. So let's assume for a moment here that the market gets over that number of 20,995. Well, 21,040 is the next number, but if you buy, do you put a stop under the most recent low? That's the problem. Give you another trade the bears might look at for tomorrow. For tomorrow, if you take out today's low of 20,766, they might say that as long as the high isn't taken out first of 20,893, if they sell that break, at least they know where their stop is. One way to look at it. They may also say if it goes up first and comes through that, you got an outside day down. I keep pointing to that for one reason, because the swing line is still down. Now, the close was just high enough today to put the market in neutral stance. You've got close over the 18-day average, the swing line down, the two fight each other. Momentum in the market pointing to the upside. You had your correction. It's now swung around to the upside. The NASDAQ also swung its momentum up. Prices are back over the 18-day average of closes. You do not have a swing line that is one way or the other. You have a higher high and a lower low, but the bias is certainly up because it's over the 18-day average. And this is the strongest of the stock indices. If it's going to make a move, 57.31, the upper Bollinger Band's probably a resistance point. On the S&P, you have a high that took out a previous high, a low that took out a previous low. You have no swing line. You have upside momentum and a market that's got upside bias because it's over the 18-day average. But I will stick my neck out again and say this seems to be where the market's going to get stuck, in the Bollinger Bands. The weakest of all the indices, I've already said the NASDAQ's the strongest, is the Russell. It does have momentum pointing up. It spent 3 days in a row under the 100-day average of closes. It looks to me as though it's ready to make an assault to the upside, but I'd be surprised if the pros don't hit it at 1388. I think they would throw in the towel if they got through the 1399.20 because they'd say, you don't have that pattern of lower highs, lower lows. And on the way back down, they might look at 1374.5 as a profit objective. Whether the market can make it back down under that, I don't know. But you have to admit, the lower Bollinger Band and the 100-day average did their job so far of supporting the market there. Where did the VIX stop? Now let's take a look all the way up here. You've got your 2 days in a row over the upper Bollinger Band. The market falls back in, stops at the 100-day average of closes in the green. What's the next support zone? 18-day average of closes, and that's about where the market finished the day off, slightly under it. Now, if you take out 1018, you've absolutely destroyed the idea that the market's trying for an uptrend. But again, it's Tuesday. You could get your Tuesday reversals. But if you take out 1018, you'll have a higher high, then a lower low, downside momentum, no trend. The first visit over the 100-day average didn't last very long again. 30-year bonds. I'm pretty amazed that the market is able to keep the gains in the bonds knowing the Fed is going to raise interest rates in June. Just before we began shooting this segment, I went and looked at the Fed watch page on the CME Group website. 78.5% chance that they're going to raise interest rates in June. The market doesn't seem overly concerned about it one way or the other. When you go to 10-year notes, backing off from the upper Bollinger Band, overbought condition, in an uptrend. But if you take out 126.01.5, you lose the uptrend. You will then have a pattern of lower highs, lower lows. Probably market makes a run for the 18-day average. Don't take that out, and I'll look for the market back at 126.10. Back to the bond market. Same period here. Take out this number, 153.12, and you could easily end up with lower highs, lower lows, make a run for the 18-day average of closes and get neutral right there. Dollar index, 5 days in a row under the lower Bollinger Band. So my rule of thumb has been that each day under counts as one of those percentage points when you understand the axiom that in Bollinger Bands, 95% of the time the market will trade within them. Now, I've seen them go to 7. You've heard me say that over and over. But I did say that the rule of thumb is 1 percentage point apiece. So would you want to go short here thinking the market can get to the right-hand side? That's going to be up to you. You are oversold, not trending. You have a higher high and a lower low, certainly downside momentum in price, riding the lower Bollinger Band. I think the market's going to move to the right-hand side of that. Now, moving to the right-hand side when you get these many days under does not generally require a big rally. You'll see that as this happens, it's sort of like this period. When you ride it, you don't get these big bounces back to the 18-day average. The market's just saying, I'm in a downtrend and the heck with y'all. Euro currency is a flip-flop, but it does not have anywhere near the amount of days over the upper Bollinger Band, 2 in a row as of today. You have an overbought condition. Could it embed? Well, both numbers today are over 80. Yesterday, Friday, both numbers were over 80, not the day before. You generally don't embed, so the odds do favor this market backing off under the Bollinger Band, the dollar coming up a little bit under it, and I use those things when I think of market positions. Now in the British pound, look at the Bollinger Bands, the black lines. Do you not agree that rallies have been stymied against it? They fall back to the support at the 18-day average of closes. You're overbought. You've been in an uptrend, but the profit objectives have been narrowing and narrowing and narrowing as this market's getting into more and more problems. You quickly turn into a downtrend in this market if 129.40 is taken out. So be a bit careful about that. It can happen on you very fast. In the Japanese yen, the market is still pointing up, but with the number at 71.67, and that's the reading right here, you're overbought. Trend has been up. Support fairly well established, 89.02 to 89.01. The 18 and the 100-day averages are right there. If you take out 89.60 roughly, you will end up with potentially lower highs, lower lows, going back to that 8900 zone and trying to figure out what next. Now, this market had a heck of a run. Is this the beginning of a rally, or was this a reaction to this big break and the market decides to resume a downtrend? In the crude oil, the crude oil has been one of these markets that has run very nicely to the upside because nobody wants to be short in front of the OPEC meeting. The problem is how much premium have you put in because OPEC is going to extend to the end of March. You've gone from roughly the $44 mark up to 51. I contend between here and 52.48. The 100-day average of closes, there's just lots of resistance in this market. And is it going to turn out to be you buy the rumor, sell the fact? Doesn't matter to me because the trend is up. Trend up, I take the name of a chart off. Until you take out on the current pattern, 48.37, the trend is up. Do you buy overbought conditions? Do you buy Bollinger Bands? Well, I teach, you do not. So I have no interest in that market. I've got the same dilemma in gasoline. It is not in an uptrend, though. It's got a lower low and a higher high, but it is overbought. And somewhere between here and the 100-day average, I would expect to see a lot of resistance. But understand the surprises in gasoline before I get off of it. At some point, America's going driving. And when they do, this market can go way on up. The next opportunity is likely a big opportunity to the upside, not the downside, simply because demand's coming on. When you go to nat gas, it's the same type of thinking, in my opinion. You have a market that's got higher lows, higher highs, it's over the key moving averages, momentum's pointing up, and what's the next thing in weather? Do you honestly think you're going to get colder and colder as you go into June, or do you think you're going to get warmer and more demand for it? So those are the seasonal factors, and you learn to trade with them accordingly. Now, a lot of what I do, we talk about, and it's different offerings that we have. And I want you to get in the habit of going to our website at www.iraepstein.com. You'll see a carousel of free offers. Just pick from it. It's that simple. And I think what you'll find is it might add something to your trading opportunities. I'm Ira. You have yourselves a great day, and I will see you all tomorrow.